Good evening. We begin tonight with a significant development in global financial markets, where precious metals are posting historic gains amid heightened geopolitical tensions and economic uncertainty. Gold and silver prices surged sharply at the start of the week, continuing a record-setting rally that analysts say reflects a broad shift by investors away from the US dollar and toward hard assets. This movement, often referred to as the debasement trade, is being driven by concerns over global instability, policy unpredictability, and the long-term strength of dollar-based investments. Gold extended its unprecedented climb, pushing past the $5,100 mark per troy ounce, setting a new all-time high. The move followed an earlier milestone as gold crossed the $5,000 threshold for the first time just 1 day prior. Trading on New York's COMEX Commodities Exchange showed gold rising as much as 2.4% before pulling back slightly from its peak. Even with that retreat, prices remained near record levels, underscoring the strength and momentum behind the rally. Silver, which is known for sharper price swings compared with gold, experienced even more dramatic movement. Prices surged more than 14% in a single trading session, briefly climbing above $116 per ounce before easing back. Despite the pullback, silver remains near new highs and has more than tripled in value over the past year. Market participants note that silver's volatility reflects both its role as a precious metal and its expanding importance in industrial applications. According to analysts, the surge in both gold and silver is not being driven by short-term speculation or online trading trends. Instead, it reflects a deeper and more fundamental shift in global investment behavior. Investors, including central banks and private market participants, are increasingly diversifying away from assets tied to the US dollar. This phenomenon has become widely known in financial circles as the debasement trade, a strategy aimed at preserving value amid concerns about currency stability and geopolitical risk. Bob Gottlieb, a former metals trader who worked at J.P. Morgan and other financial institutions, described the rally as grounded in structural changes rather than market hype. He said the current rise in precious metals prices reflects the ongoing de-dollarization of the global economy, with central banks seeking to protect themselves from U.S. policy decisions and what he described as unpredictability in American actions. His comments underscore a growing perception among investors that traditional safe havens may no longer provide sufficient protection during periods of international tension. The renewed interest in gold has been building for several years. Numerous central banks significantly increased their gold purchases in 2022, coinciding with the onset of the war in Ukraine. That buying activity accelerated again in early 2025 when trade disputes initiated by President Donald Trump disrupted global markets. More recently, those anxieties have resurfaced as the Trump administration has taken a more assertive foreign policy stance, contributing to market uncertainty and renewed demand for safe haven assets. In recent weeks, geopolitical developments have played a notable role in shaping investor sentiment. The administration's actions have included a military operation resulting in the capture of Venezuelan leader Nicolas Maduro, as well as threats directed at European leaders over U.S. demands related to the annexation of Greenland. These events contributed to volatility in financial markets, with U.S. and global stock indexes initially selling off before stabilizing as tensions eased somewhat. Additional uncertainty emerged over the weekend when President Trump threatened Canada with a 100% tariff. He stated that such a measure would take effect immediately if Canada pursued a trade agreement with China. However, Canadian Prime Minister Mark Carney had announced the agreement a week earlier, a move that had initially drawn praise from President Trump. The conflicting signals added to the sense of unpredictability surrounding trade and foreign policy, reinforcing investor interest in assets viewed as stores of value. Market strategists say this environment of shifting geopolitical risks continues to support higher prices for gold. Adam Turnquist, chief technical strategist at LPL Financial, characterized the current global backdrop as one marked by recurring and unresolved conflicts. He said that this ongoing pattern contributes to a risk premium in gold, as investors seek protection against sudden market disruptions and policy shocks. The rally in precious metals has not been limited to gold and silver alone. Other metals have also recorded notable gains. Copper prices have been driven higher following the imposition of a 50% tariff on finished products by the Trump administration in July. That policy move has affected supply dynamics and contributed to rising futures prices. Meanwhile, futures linked to platinum and palladium, both of which are widely used in automotive catalytic converters and other industrial applications, have climbed more than 25% since the beginning of the year. Analysts also point to currency movements as a key factor behind rising metals prices. The US dollar fell again on Monday morning, reaching its lowest level since September. A weaker dollar tends to make commodities priced in dollars more attractive to foreign investors, whose currencies gain strength by comparison. As a result, demand for non-dollar investments, including precious metals, has increased, providing additional upward pressure on prices. Equity markets, meanwhile, showed more moderate movement. Stocks edged higher as trading progressed, with major indexes posting modest gains. The S&P 500 closed at 6,950.23, up 0.5% on the day. The Dow Jones Industrial Average rose 0.6%, finishing at 49,412.40. The Nasdaq Composite Index, which is heavily weighted toward technology stocks, gained 0.4% to close at 23,601.36. These movements reflected a measure of stabilization in equity markets even as investors continued to favor hard assets. Silver's recent surge has also been influenced by longer-term trends in industrial demand. In recent years, the metal has seen growing use in technologies such as solar panels and data center infrastructure. According to Gottlieb, silver stockpiles on the Chicago Metals Exchange have declined as shipments move out of the United States to other regions, tightening supply and contributing to higher prices. Beyond institutional and industrial demand, retail investor interest in gold and silver has increased sharply during the rally. Many individual investors are seeking to benefit from rising prices, adding another layer of demand to already tight markets. Data from the World Gold Council, a trade organization, shows that gold-backed investment funds in North America added a record approximately $51 billion in 2025 alone. That trend has continued into the new year. According to Joe Cavatoni, the World Gold Council's chief markets strategist, those funds added another $5 billion in just the first few weeks of 2026. He said that what the organization is observing is a sustained increase in retail demand for gold in the United States, with interest continuing to rise rather than taper off. However, the growing popularity of gold and silver at historic price levels has also raised concerns among some personal finance experts. They warn that investors who enter the market late may face risks if prices reverse. Morningstar portfolio strategist Amy Arnott noted that despite gold's reputation as a safe haven, it can experience significant volatility during periods of market turmoil. Arnott cautioned that sharp price swings can occur even in assets widely viewed as stable, and that investors should remain aware of potential downside risks. Her remarks highlight a note of caution amid the broader enthusiasm surrounding the metals rally. As gold and silver continue to trade near record levels, attention remains focused on the interplay between geopolitics, currency movements, and investor behavior. The forces driving this rally are complex and deeply intertwined with global economic and political developments. In the next part of our report, we will take a closer look at how central bank actions, trade policies, and industrial demand are shaping the trajectory of precious metals markets, and how these factors are influencing investor strategies around the world. As the rally in precious metals continues to draw global attention, a closer examination of the underlying drivers reveals a complex mix of policy decisions, institutional behavior, and shifting investor priorities. Central to this surge in gold and silver prices is a growing movement away from reliance on the U.S. dollar, a trend that has gained momentum over several years and has accelerated during periods of geopolitical strain. Analysts describe this shift as structural rather than temporary, reflecting broader concerns about currency stability and the long-term direction of global economic governance. The concept commonly referred to as the debasement trade has become increasingly prominent in market discussions. At its core, this strategy involves reallocating capital from dollar-denominated assets into tangible stores of value, such as precious metals. Investors pursuing this approach are seeking insulation from perceived risks associated with fiscal policy, trade disputes, and international conflict. The recent performance of gold and silver suggests that this strategy is now being adopted at a much larger scale than in previous market cycles. Gold's rise past $5,000 per troy ounce represents a historic moment for the metal, marking an unprecedented valuation in nominal terms. The move did not occur in isolation. Instead, it followed a sustained period of accumulation by large institutional players, including central banks. Data shows that central bank gold purchases increased significantly in 2022, coinciding with the outbreak of the war in Ukraine. That conflict disrupted global energy markets, heightened inflationary pressures, and exposed vulnerabilities in international financial systems, prompting policymakers to reassess reserve strategies. In early 2025, those concerns were amplified by renewed trade tensions stemming from actions taken by the Trump administration. Trade wars during that period disrupted supply chains, unsettled currency markets, and introduced new uncertainties into global commerce. As a result, central banks in multiple regions accelerated their gold buying programs, seeking to diversify reserves and reduce exposure to U.S. policy decisions. This institutional demand provided a strong foundation for the price increases seen today. Recent geopolitical developments have further reinforced these dynamics. In the weeks leading up to the current rally, global markets reacted to a series of foreign policy moves by the United States that contributed to heightened uncertainty. Among them was a military operation that resulted in the capture of Venezuelan leader Nicolas Maduro, an event that reverberated across international markets and raised questions about regional stability. Additionally, tensions escalated following statements directed at European leaders concerning U.S. demands related to the annexation of Greenland. These developments initially triggered a sell-off in both U.S. and global equity markets, as investors reassessed risk exposure. While stock markets later steadied as immediate tensions eased, the episode reinforced the appeal of assets traditionally viewed as hedges against geopolitical turmoil. Gold, in particular, benefited from this renewed risk aversion, with prices continuing to climb even as equities recovered. Trade policy has also played a critical role in shaping investor behavior. Over the weekend, President Trump threatened to impose a 100% tariff on Canada if Ottawa pursued a trade agreement with China. He stated that such a measure would be implemented immediately under those circumstances. However, Canadian Prime Minister Mark Carney had already announced the agreement a week earlier, a move that had initially received positive remarks from President Trump. The mixed messaging added to market unease, underscoring concerns about the predictability of trade relationships. Analysts note that such policy uncertainty tends to favor hard assets. When trade rules and diplomatic relationships appear subject to sudden change, investors often seek assets that are less directly tied to political decision-making. According to Adam Turnquist of LPL Financial, the current global environment resembles a series of unresolved conflicts that emerge and recede without clear resolution. He described this pattern as a whack-a-mole backdrop in which new sources of tension continually arise, sustaining a risk premium in gold. Silver's performance, while influenced by many of the same macroeconomic factors as gold, also reflects additional dynamics unique to the metal. Silver is both a precious metal and an industrial commodity, a dual role that contributes to its higher volatility. On Monday, silver prices spiked more than 14%, briefly exceeding $116 per ounce before retreating. Even after the pullback, silver remained near historic highs and continued to show strong momentum. Over the past year, silver prices have more than tripled, driven in part by expanding industrial demand. The metal plays a growing role in renewable energy technologies, particularly in the production of solar panels. It is also increasingly used in data center infrastructure, a sector experiencing rapid growth. These industrial applications have tightened supply and amplified price movements during periods of heightened investment demand. Supply-side factors have also contributed to silver's rally. Bob Gottlieb noted that silver stockpiles on the Chicago Metals Exchange have declined in recent months as shipments leave the United States for other destinations. This reduction in available inventory has placed additional upward pressure on prices, particularly during periods of strong buying interest. While gold and silver have captured most of the headlines, other metals have also recorded notable gains, reflecting broader shifts in commodity markets. Copper prices have been driven higher following the introduction of a 50% tariff on finished copper products imposed by the Trump administration in July. That policy move altered trade flows and influenced futures markets, contributing to rising prices. Platinum and palladium, both of which are widely used in automotive catalytic converters and various industrial processes, have also seen substantial gains. Futures linked to these metals have risen more than 25% since the beginning of the year. Analysts attribute these increases to a combination of industrial demand, supply constraints, and the broader trend of investors seeking exposure to physical assets. Currency movements have further reinforced the upward trajectory of metals prices. The US dollar continued to weaken, falling again on Monday morning to its lowest level since September. A declining dollar typically makes commodities priced in dollars more attractive to investors holding foreign currencies, as their purchasing power increases. This dynamic has encouraged additional foreign investment into gold, silver, and other metals. Despite the strong performance of precious metals, equity markets have shown relative resilience. Major U.S. stock indexes recorded modest gains, signaling that investors are not abandoning equities altogether, but are instead diversifying portfolios. The S&P 500, Dow Jones Industrial Average, and NASDAQ Composite all closed higher, reflecting a degree of confidence that markets can absorb geopolitical shocks while maintaining overall stability. At the same time, the contrast between the steady rise in equities and the sharp surge in metals highlights a broader reassessment of risk and value. Investors appear increasingly focused on balancing growth opportunities with protection against uncertainty. This dual approach has supported demand for both stocks and hard assets, though the pace of gains has differed significantly between the two. As these trends continue to unfold, attention is turning toward the role of individual investors and the sustainability of current price levels. In the next part of our report, We will examine the surge in retail participation, the flow of funds into gold-backed investment products, and the concerns raised by some financial experts regarding volatility and potential downside risks. As gold and silver continue to trade near record levels, attention remains focused on the interplay between geopolitics, currency movements, and investor behavior. The forces driving this rally are complex and deeply intertwined with global economic and political developments. In the next part of our report, we will take a closer look at how central bank actions, trade policies, and industrial demand are shaping the trajectory of precious metals markets, and how these factors are influencing investor strategies around the world.